this Powell sort of statement that we got and the press conference that followed, was this really as dovish as what markets are anticipating?
Good morning. Well, I certainly think it's in line with what the markets were thinking. There was always a debate about whether they would be holding rates or hiking rates. I mean, with inflation at 6%, it did seem sensible that they would hike rates, given they're trying to remain credible. But they had to follow what other central banks have done in the last week and really outline this blueprint for waiting and watching to see the data, recognising there are these new stresses in the financial and banking sector. And they really have to be cognizant of the fact that they are going to weigh on growth. So I think it was a case of roughly in line with what the market expected. There may have been a few things in there in terms of the willingness to hike rates again, the fact that we saw a more of a dispersion of spread across the dots in terms of where that median dot would be in the coming years, and the fact they still think that the inflation outlook is quite high in their forecast period. So I think there was a lot to digest there, but largely was in line with what the markets are thinking about. And Janet Yellen, I mean, they've got to try and avoid moral hazard in the banking sector, and they can't come out and say they're just guaranteeing all deposits. But that's very different than thinking about weakness in the banking system in the US, which is fundamentally quite strong. We don't see a systemic risk in the financial sector across Europe or the US at the moment.
Yeah, Kerry, I think we heard also from Jane Fraser of Citi earlier on, who talked about that's just a pocket of the U.S. banking market. How does this all translate then into investment strategy? We talked about how you're still leaning defensive. What does that mean exactly?
Well, I think it is the right place to be. I mean, there is so much uncertainty. I think that the growth outlook in the US is going to deteriorate further from here, given that we have those lending standards rising and potential for credit conditions to tighten further. The risk around another rate hike from the Fed is still very much present, while we still have sticky inflation. So all that weighs on the growth outlook, it weighs on the earnings outlook, and while we may have seen somewhat of a bottoming in earnings revisions, there's also downside risk to that. So we would be thinking very much more defensively about a quality bias and equity positions, looking for large companies that have provided that strength in the balance sheet and potential for cash flow. So that leans you towards some sectors like technology and those big companies there, but also towards things like healthcare, which have that lower inflation sensitivity, and even utilities as well. So that bias is very much present in our thinking around equities. And also when it comes to fixed income, we actually prefer bonds over equities at this point in time, thinking about the investment grade outlook and also extending duration as we see yields, any pickup in yields, it would be an opportunity to add to that duration profile.
Swaps think that, you know, this is the end, or we're getting close to the end of this tightening cycle, Kerry. And I wonder, should investors look at a Fed pivot a lot more differently now in the wake of this sort of banking turmoil that we've seen in the U.S. and that, you know, if I continue to see credit conditions deteriorate, what does that mean for the economy or earnings, for example, as well? So is a Fed pivot necessarily a good thing for markets?
Yeah, when it comes to the credit conditions, obviously they move hand in hand with thinking about where growth goes. They're not necessarily a leading indicator. They sort of seem to happen at the same time. You know, credit is just oxygen for the economy. The more you restrict it, the more the economy and economic growth gets choked off. So I think it's a case that those conditions are very much tightening. There is going to be that prevalence of that continuing. I mean, those conditions and those indices we watch on that have been moving higher since the Fed started hiking rates, so it shouldn't really be too much of a surprise. And that does mean we think about the outlook for the economy being of one that's probably going to be weaker in this environment, and one where you need to position for that cost of thinking about what that means for the outlook for earnings. I think more importantly, when it comes to the pivot with the Federal Reserve, I mean, Jerome Powell sort of pushed back on the idea that we're going to cut rates this year. He said it wasn't their base case. But, I mean, if we are thinking about a recession beginning in the latter part of this year, I think there is a case to see the Fed actually cut rates we head towards the end of this year and more into 2024. So we shouldn't rule it out completely.